Thanks for tuning into Worldview. I'm your host, Niraj Shah. We have a very special guest today. I've never spoken to him before. I don't think too many people in India have, but he's the Chief Emerging Market Equity Strategist at JPMorgan. And he and his colleagues recently upgraded India to an overweight. Pedro Martins Junior joins us on the show. Pedro, great having you. Thanks for taking the time out.
Niraj, my pleasure. Thank you for the invite and the opportunity.
The pleasure is entirely ours. Pedro, I want to start off with your worldview and then bring it down to the reasons for upgrading India to overweight. But currently, risk assets surrounded by almost every negative that you could think of, which is the higher yields, geopolitics, and not just one, but at two fronts or maybe more. And the fact that there's a lot of talk of refinancing risks for equities, including the EM equities worldwide, being a clear and present agent to earnings. How sanguine or not sanguine are you on risk assets, particularly equity markets?
Niraj, the beginning of this conversation is not the greatest. We're not constructive in risk assets, indeed, at the global asset allocation level. House view remains cautious. Key reasons, interest rates moving higher, and I think the elephant in the room are rates in the US, short end and long end. Number two, the valuation in parts of the global asset allocation markets remain expensive, and there is overhang of geopolitical risks. So our global asset allocation recommendation is to maintain a defensive allocation to our model portfolio. We are underweight in equities and credit versus overweight cash and commodities. Particularly to equities, we stay underweight global equities within the global asset allocation framework because we see kind of a double negative impact for corporates, notably in the US. The peak of inflation impacts negatively pricing power. We see obviously with this slowing growth in the US into next year, less volume growth. And also there is kind of a double negative impact for households. So there is a concern about the exhaustion of the cushion of the consumer excess savings that were accumulating during COVID. And the Fed is trying to do its job to inflict pain into the labor market to create the inflection point. So the road bumps are plenty, right? So equity valuation multiples derating, plus some risk for EPS expectations.
All right. In some sense, Pedro, if there used to be a Fed put in place for a better part until 2021 or thereabouts, almost seems like there is a Fed call in place now. At the first whiff, there is an action which doesn't quite please risk assets like equities.
Yeah. Maybe Fed call is a little bit of a stretch to the bear side, but it's fair to say, Niraj, that in our horizon, there is no hurry for the Fed to cut rates in the US. In our base case, we're forecasting the Fed to cut second half of next year. So that means we're going to be dollar plus 5.5, give or take, for another 3, maybe 4 quarters. And that's serious competition for risky assets.
Yeah. And in such a scenario, I mean, usually at such times wherein a risk-free rate is so high, there is not necessarily a very strong appetite for emerging market equities. What's your sense of when does this come back, if at all, and what are the factors that could lead to that?
Niraj, indeed, the near-term outlook is challenging. So let's separate this in 2 blocks. Do we have the fundamentals as EM equities to attract capital? I would say yes, there is a massive underallocation of global funds into EM assets, notably equities. There is undervaluation of EM equities relative to developed markets adjusted for the historical discount. There is a sense that there is value emerging also in other parts of EM, such as rates and FX. But essentially, we need a catalyst, right? So I can construct you a medium to long-term positive view on EM, but I need a catalyst. And unfortunately, we are not seeing that catalyst emerging anytime soon. So in our conversations with clients, it feels like they need a reset in the US machine for the risk appetite to reemerge. What is this reset? They need to see the economy slowing. With that economy slowing, inflation slows, and that creates sustainable conditions for the Fed to cut rates. Maybe this process is going to be developing throughout 2024, but it's not an immediate one. So we need a reset in the US machine. So that'll be my short answer to your question.
Yeah, I saw in your note that the house view is that the US GDP growth will significantly go down in 2024 to 1.3 from 2.3. My only question is, hitherto, most predictions around what happens to the labor market and the economy or to rates have gotten pushed out by at least 2-3 quarters, thus far at least. Could it therefore well happen that while the house view is this, could the US economy deceleration get delayed due to a factor or two, or do you believe there's a higher probability of we seeing these numbers or circa these numbers in 2024 itself?
Yeah, it's a great question, Niraj, because in reality, what you described was what happened throughout 2023, right? So, which is beginning of this year, everybody was forecasting the US to slow, and in essence, that slowdown in the US economy didn't materialize. As you look forward, we don't think the stronger for longer US growth coexists permanently with the higher for longer US rates. So one variable conflicts with other, and at some time they talk. So we think this process will be developing into next year, producing a very weak growth pattern for the US, particularly in the first half of next year. So that's the economic view. The other part of the answer is the markets, right? So I was recently in a roadshow with US investors that was a week and a half back, and the feedback from the real money managers is that, okay, I take your view, but I have no hurry to execute because, as you said, the view proved wrong throughout 2023. So I think investors will be waiting for confirmation before acting on this view. And two, there is a cohort of investors out there that they are concerned that you might swing from growth in the US to scarce growth in the US, and that ignite a little bit of a frenzy, right? So as to, okay, do we have a problem in illiquid markets, private credit and equity? Do we have a problem in the real estate market? So for EM, if you think about the dollar smile growth, we are here too hot, doesn't work for EM because investors say, I don't need to leave US assets. But if you move too fast to too cold, it's risk off, right? So we need to be at the belly of this mile. And investors, I think, will be erring on the cautious side this time around and not trying to anticipate the views.
Okay. Now, EM, while the investments into EM funds happens as more like a basket, we know that EMs are not necessarily having the same characteristics of growth/risk. Now, you in your notes cite that the differential between the EM versus DM growth in 2024 could well drive appetite for EM equities. My question, therefore, is that since all EMs don't behave equally, what if we see select EMs, I include India out there, and maybe one or two others, showing that kind of growth that is anticipated of them, but some others fail? In which case, what happens to risk appetites towards EMs? Does it still stay quiet because it's not evident in a bunch of economies? Or would investors be willing to make individual country bets in a larger way than what it has been seen in the previous decades, if you will?
Niraj, that's a great point because there is great confusion when it comes to discussing those pots, right? So pot number one is, are we as an asset class, EM equities, attracting money from global equities? And the short answer to that is no. right? So since third quarter of this year, we're losing money. And this is a battle for a $25 trillion pot, which is the global AUM of equity dedicated money. So that battle temporarily, we're not winning, EM versus the M. The other battle, which is more interesting and aligns best with your question, is that within the EM pot, how to outperform, right? So this EM pot of equities, it's an amount of money close to $1.5 trillion of mutual funds. It's a lot of money, right? So within this EM pot, we have been aligning our portfolio towards endogenous growth stories within emerging markets. Okay? So the investors look into growth compounders in EM, particularly as an alternative to China, because still there is some anti-China sentiment regarding adding more risk. And they think about four countries, basically. India, top of the list, and we can debate there in more details later. Second, Indonesia, and outside of Asia, Saudi Arabia and Mexico. So that's one way to express growth compounding strategies within EM. The other strategy that is also very popular these days is to become a partner of the cyclical bounce of China GDP, but not necessarily adding risk to China equities. How come, right? You can look into north of Asia and see all the tech complex, Korea, Taiwan. You can look into the south of Asia and see the cyclical ASEAN market. So think about Thailand tourism. And then you can look ex-Asia and think about commodities. And that draws attention to the Middle East, to Brazil, and Chile, for the most cases.
Got it. Okay, so play China, but play China indirectly if you want to play the cyclical bout. On a structural one, I think you mentioned that India stands out right there. Is that one of the reasons why you upgraded India to overweight recently? I believe it was 26th of October.
Yeah, I'm glad you're reading our reports. Thank you for that. Well, the reasons as to why we upgraded India are basically two, right? There is a cyclical component to it. So the Indian equity market corrected. It was down at some point close to 10% in the recent past. I think this is closely related to the derating of the S&P 500, right? So higher rates, it's a headwind to high Ps. That happened in the US. And India obviously got the collateral damage for that. So that's one reason to use this near-term correction to add. And also there is, maybe it's a little bit too early, but we prefer to be early than late, and sorry, the positive historical seasonality of Indian equity market returns to general elections that will take place into next year. So those are the cyclical factors. The structural ones, I think are well known. But it's worth refreshing, right? So India has the strongest nominal GDP compounding within EM. And that reflects demographic infrastructure investments, the fact that the government has been shrinking and giving space to the private sector, and also from a return to risk perspective, the Sharpe ratio, India ranks amongst the best within EM. So I would then cluster those two things, right? So the why now, the cyclical factors, and the structural ones that don't change much, right? So they'll be there for good and bad times.
Yeah. And so I'm very happy to hear about the structural factors predominantly, because that would entail that there is longer term stable flows into India, coupled with the fact that the Indian bond markets now being included in the JPMorgan index and maybe some others with due course only gives more access and more fungibility to bond investors as well. Is that also a factor which strengthens this hand, Pedro, or not quite?
Yeah, we will also debate and give some light into that. So what is happening in a broader sense is that the Indian bonds or fixed income instruments will be part of an important benchmark for global investors tracking bonds globally. And theoretically, once you include or increase the weight in those indices, you attract inflow of money, right? And that could have some tangible benefits in this case of India increasing its weight in this important index. One is capital inflows. So it's temporary, it's concentrated, but it could anchor currency appreciation. And the second one, and more hopefully, it might anchor long-term financing costs for Indian companies lower, right? And obviously those two factors, so currency strength plus lower cost of debt for the long term, they will be topping out on the structural factors to help Indian companies compound EPS faster. So that's indeed a good development.
Got it. Pedro, I have two more questions. I believe I still have time with you for 3-4 minutes. If I can slip in one or two questions more, I can.
Sure.
Great. The other aspect is there's so much of importance attached to elections. Now, you mentioned that you're playing that seasonality, but from a lot of other investors or global experts that I speak to, everybody's watching with a keen eye as to what happens in the elections, general elections 2024. I would love to understand if you and your team particularly are giving it outsized importance, part one. To the investors that you speak to, are they giving it outsized importance this time around?
I think the mother election we're going to see in 2024 is the US election, right? So in which I won't speculate about the result, but you're going to have, again, the classical confront of Democrats and Republicans. We don't know yet who are going to be the actors to that. And I think that will carry some meaning as to whether industrial policy in the US becomes more inward-looking or outward-looking, if geopolitics of the US gets smaller and bigger, and the implications for the dollar, the willingness or not to tackle fiscal deficits. So that's the most important election. I think beyond the US, the second election that has been mostly watched by the EM-dedicated investors is the one in Mexico, because Mexico recently has been benefiting of nearshoring, friendshoring trends. So there is a lot of debate of who's going to be the successor of President López Obrador, and if the successor carries out the good momentum for nearshoring, friendshoring. In particular to India, I think the discussion is more of a tactical opportunity, that there is not a structural risk on the table in which investors are particularly concerned about India related to elections. So it's more about how much of this might impact cyclically GDP growth out there.
Got it. My final question, Pedro, because you would have seen many such cycles of economies going through the kind of transition that Indian economy is going through, part one. You would have spoken to a bunch of investors recently about this whole India fanfare. I mean, we saw evidence of that at multiple global forums, including the World Economic Forum and some others. Are a completely new set of investors looking to make large investments into India? I'm not talking about FDI, but more like institutional flows into equities per se. Do you encounter such conversations with people who hitherto may not have thought of India as a very large market, but are now wanting to explore and maybe invest into India meaningfully?
Niraj, to conclude, I think in the equity world, there are two interesting things here. Okay. Number one is that as China real GDP slows, so India now is delivering stronger real GDP than China. And the nominal GDP of India is even larger. So the power of nominal GDP compounding as a proxy of EPS GDP compounding is growing larger in favor of India. And that should be anchoring immediate, medium, long term flows within EM to be biased towards those high compounding areas. The second element to mention is that there is real life effective pressure for investors, US-based investors, to diversify away from China equities. So some pension funds in the US are already tracking off their EM equity exposure 50% MSCI EM, in which China weights 30%, and the other 50% of the funds are tracking MSCI EM ex-China. So synthetically, those funds in the US have now a neutral of China 15%, not 30 in the usual benchmark. And that forces reallocation of money elsewhere. And clearly, India is one of the recipients of this reallocation of money.
Great. Pedro Martins Jr., take a moment to thank you for joining us today. We just at the cusp of the biggest festival in India. And to you and your team and family, from all of us here, wishing you a very happy Diwali. And thank you for taking the time out.
The pleasure is mine, and I wish you a colorful Diwali as well.
Thank you so much. And viewers, thanks for tuning in.